Until the 19th century, insurance had largely been a matter of private commerce, merchants and ship owners protecting their property and cargoes. The idea that the state itself might organize insurance to protect working people from the hazards of industrial labor was a profound conceptual leap, and it was taken most decisively by Otto von Bismarck, the Iron Chancellor of the newly unified German Empire. In 1871, Germany enacted a law requiring employers to compensate workers injured in industrial accidents, establishing the principle that the costs of workplace injury should be borne by industry rather than by workers alone. This was followed in 1884 by the Accident Insurance Law, part of a sweeping program of social legislation that also included health insurance and old age pensions. Bismarck's motivations were partly pragmatic. He sought to undercut the appeal of socialist movements by demonstrating that the imperial government could care for workers' welfare, but the consequences were transformative. Germany's system of compulsory social insurance became the model for workers' compensation and social insurance programs across the world, establishing the principle that insurance need not be purely voluntary or purely commercial, but could be a mechanism of social solidarity organized and guaranteed by the state. In the United States, the development of insurance followed its own trajectory, driven by the expanding needs of an industrializing nation. The Travelers Insurance Company, founded in Hartford, Connecticut in 1864, was a pioneering institution in American insurance history. By the 1880s, Travelers had moved well beyond its original focus on accident insurance for travelers, a product famously illustrated by its first policy, which insured a man for $5,000 against accidental death for a 2-cent premium covering a walk from the post office to his home. By 1884, Travelers was expanding its offerings to encompass a broader range of risks facing ordinary Americans in the industrial age. Travelers represented the American insurance industry's growing ambition and sophistication, the recognition that insurance was not merely for wealthy merchants protecting exotic cargoes, but for working men and women navigating the everyday hazards of modern life. The insurance industry that emerged from the 20th century bears little surface resemblance to the Genoese marine contracts of 1347 or the handshake agreement struck at Lloyd's Coffee House in 1688, yet its animating principle, that shared risk is manageable risk, remains entirely unchanged. What has transformed is the almost breathtaking complexity and scale of the instruments through which that principle is now expressed. At the apex of modern insurance architecture sits reinsurance, quite literally, the insurance of insurance companies. When a primary insurer writes policies covering homes, lives, or businesses, it assumes enormous cumulative exposure. To protect itself against catastrophic losses, a single hurricane that generates billions in claims, or a pandemic that triggers simultaneous payouts across millions of policies, the primary insurer transfers a portion of that risk to a reinsurer, paying a premium in exchange for coverage. Reinsurance is a financial arrangement in which an insurance company transfers a portion of its risk to another company to protect itself against significant losses, helping insurers manage risk, stabilize financial performance, and maintain solvency in the event of catastrophic occurrences such as natural disasters or economic crises. Dominant players include Munich Re, Swiss Re, Hanover Re, Berkshire Hathaway Reinsurance Group, and the enduring marketplace of Lloyd's of London, with Munich Re alone commanding over 13.7% of the global market share in 2025, as the industry adapted to demands for AI-driven risk analytics and real-time catastrophe modeling. Layered above and alongside reinsurance are a series of financial derivatives that blur the traditional boundary between insurance and capital markets. Chief among these are credit default swaps, or CDS, instruments whose insurance-like function and catastrophic misuse reshape the global economy. A credit default swap is a financial swap agreement in which the seller of the CDS agrees to compensate the buyer in the event of a debt default or other credit event. In essence, the seller insures the buyer against a reference asset defaulting, with the buyer making a series of periodic payments, analogous to insurance premiums, in exchange for a promised payout if default occurs. The CDS market expanded with extraordinary speed. By year-end 2002, outstanding CDS contracts exceeded $2 trillion, and in 1997, JP Morgan had developed a pioneering product called Bistro, Broad Index Securitized Trust Offering, that used CDS instruments to clean a bank's balance sheet by splitting credit risk into smaller pieces more digestible to individual investors, creating what became the first synthetic collateralized debt obligations. Insurers have increasingly turned to alternative capital sources, including catastrophe bonds and insurance-linked securities, which connect financial markets directly to disaster events. Alongside catastrophe bonds, parametric insurance has emerged as a transformative product. Unlike traditional indemnity-based policies, which require detailed loss assessment before a claim is paid, parametric insurance pays out if a particular event occurs: wind speed exceeding a threshold, rainfall surpassing a set level, offering certainty and flexibility that traditional policies cannot match, with Munich Re Capital Partners alone fielding more than 1,000 requests a year for parametric policies by 2025. Taken together, these developments reveal an insurance industry that has undergone a fundamental philosophical expansion. What began in ancient China as merchants redistributing rice jars across boats, and what solidified in Genoa in 1347 as a written contract between merchants and underwriters, has now become a vast, interlocking system in which traditional insurers, reinsurers, capital market investors, hedge funds, and sovereign governments all participate in the shared project of managing uncertainty. The history of insurance is, at its heart, the history of human ingenuity in the face of uncertainty. From Chinese merchants distributing rice jars across multiple boats on the Yangtze, to Babylonian merchants protected by the laws of Hammurabi, to medieval guild members pooling resources for one another's relief, to Genoese notaries drafting the first formal marine policies, to London coffeehouse habitués signing their names beneath ship descriptions, to Bismarck transforming insurance into a pillar of the modern welfare state. The thread running through all of it is the same: no one can eliminate misfortune. But by sharing its weight, human societies have found ways to make it bearable. That insight, ancient and enduring, is the foundation upon which the entire edifice of modern insurance rests.